It's been a difficult year for both the stock and bond markets. With rising interest rates and high inflation driving so much of performance in 2022, how much higher can rates go? Last week's higher than expected inflation report was a game changer for the Federal Reserve and bond markets, with inflationary pressures continuing to run much hotter than the Fed's 2% target. An even more aggressive rate hiking campaign was priced into markets. Markets are now expecting at least a 75 basis point increase in its short-term interest rate, and nearly another 100 basis point of hikes in the two remaining meetings this year. Moreover, markets expect the Fed funds rate to get to 4.5% by early next year. Because of the high Fed rate hike expectations, the yield on the 10-year Treasury security has increased by nearly 200 basis points, or 2%, this year, after increasing around 100 basis points in 2020, and is at the highest level since 2011. The nearly 300 basis point move higher that has already taken place in this cycle is the biggest move higher in yield since 1987, when rates moved higher by 320 basis points. We're clearly not in normal times, but the move on the 10-year Treasury yield since it bottomed in August 2020 has been significant. Could rates still move higher? They will ultimately depend on the path of inflation. If inflation falls like we continue to expect it to, yields will likely fall as well. If inflation stays elevated and the Fed has to be even more aggressive than what is currently priced in, we could still see higher rates. However, as Fed rate hikes flow into the real economy, the risk of a recession increases, which should help bring down yields. As such, we still think the 10-year Treasury yield can end the year between 2.75% and 3.25%, but we acknowledge there are risks to the upside. The shape of the yield curve is not normal. Over the past 6 months, the Fed has been aggressively raising short-term interest rates in an effort to arrest these continued consumer price increases and deliberately slow the economy. So, when we look at the current yield curve, we see that the 2-year yield is out-yielding the 10-year Treasury yield and is thus inverted. Maybe more concerning, though, is that the 3-month to 10-year part of the yield curve is getting close to inversion as well, a signal with more academic backing. As you can see in Figure 2, over the past few decades, economic recessions have occurred shortly after these yield curve inversions have taken place. Could this time be different? Absolutely, but as the Fed continues to push short-term interest rates higher to slow the economy, recession risk will remain a concern for investors. While we don't think a recession is likely this year, we do think it's roughly a 50-50 proposition in 2023. And as long as there are concerns about a slowing economy, we could see either stable or lower long-end rates. Quantitative tightening is a wild card. The Fed has stated that it would like to get its nearly $9 trillion balance sheet back down to roughly 20% of U.S. GDP. It is currently closer to 40% of GDP. The unanswered question remains, though, how far can the Fed actually go in reducing its balance sheet? Last time the Fed attempted to shrink its balance sheet, it was only able to remove roughly $750 billion of Treasury and mortgage securities before certain parts of the short-term funding markets, which are important corporate funding markets, experienced stress. Existing liquidity in many government bond markets remains poor, so the Fed will likely have to proceed cautiously to ensure the most important bond market, the Treasury market, remains fully functional. Given the pockets of illiquidity in the Treasury markets, we could see the yields gap higher if inflationary pressures continue to surprise markets. In conclusion, with the move higher in yields, 2022 will likely go down as the worst year for bonds ever. Could yields go higher from current levels? A lot will depend on the path of inflationary pressures. If Fed rate hikes start to work and inflation starts to fall, then yields will likely fall as well. If inflation pressures remain stubbornly high, we're likely to see higher yields to follow. Please take a moment to review these important disclosures.